Ben Graham created this Mr. Market character to explain the schizophrenic nature of the stock market. And in essence, what it does, it explains why company A will trade for a really good price one day and trade for a really bad price the next day when there's really no news that has come out that would potentially impact the sentiment.
I love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by
Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks, welcome to Investing for Beginners podcast. Welcome to 2026. Today will be the first show that you will hear us in 2026. We hope you had a great holidays and a happy and safe New Year's Eve. And welcome to the show and the stock market. And let's get to learning more about investing. So today we thought we would talk about the intelligent investor. I know I hear all the groans out there. Oh, why are you guys talking about that tired old book? And I know it's become in vogue to bash the intelligent investor and put it down. And while yes, maybe some of the formulas are maybe not up to date, the core principles behind this book are timeless. And our good friend Warren Buffett, Ben Graham's most famous student, he is quoted as saying is by far the best book on investing ever written, and credits chapters 8, Mr. Market, and chapter 20, Margin of Safety, as the most important books or chapters in stock investing writing. So I think I always do a re-listen of The Intelligent Investor every year in January. So Andrew and I thought it would be appropriate to touch on some of the timeless themes that are you can learn from the book. So with that, I'm going to turn it over to Sir Andrew and we'll start talking about The Intelligent Investor.
Yeah, this was the second book I ever read about investing. And it really it shapes the way you think about investing. And then the way that it shapes your investing comes through in your mindset, your ability to handle your emotions. All these things that happen in the background that you're not aware are happening, they happen when you set the foundation in place. And so The Intelligent Investor is a foundation book for so many people. So I don't care what you think. If you think it's outdated, you're wrong. And you should, if you don't understand these fundamentals, you're not going to be a good investor. Maybe you will one day, but you're going to make a lot of mistakes along the way, and those could be painful. So why not dig the foundation now? One of the first topics that's mentioned in The Intelligent Investor, which sounds basic, but maybe there's a little more to it. This idea of investing versus speculating. Lay out kind of some of the mind frames, some of the ways people think about those two ideas and why you shouldn't try to mix, one with the other.
Right. I think most people, when they think of the stock market, especially people that are newer to investing or the stock market, kind of think of the terms as interchangeable, that investing and speculation kind of go hand in hand. And it couldn't be further from the truth. And a lot of it is because people associate investing with gambling. They feel like it's gambling because there's lots of price movements. You hear all these stories of people making, millions and losing billions. And so it just seems like this wild, wild west. And while there is some aspect of that, depending on how you invest, the vast majority of the money moving in and out is actually a fairly structured, organized manner, and it is guided by emotions. So that also kind of leads to some of the volatility that you're going to see. But the easiest way to break it down is investing and speculation. Investing is a term that you would use when you're doing any sort of analysis or trying to learn about the business that you're going to buy. That's investing. So when you buy a company, when you buy a piece of stock of Google, when you buy $100 worth of Google, you are now a shareholder of Google, and that is investing. when you are looking at the price and seeing it go up and down and trying to bet on whether it's going to continue to go up or whether it's going to continue to go down, that is speculation, because that is solely based on the price movement of the company, not the fundamental analysis, not trying to learn about what is this business, how does it operate, why do people like it, why do people hate it, and you're just looking solely at where the price goes and where you think the price is going to go. That is speculation. And they are two vastly different kinds of investing. There are people that can do the speculation part really well. I am not one of them, and I don't want to be one of them. But there are people that can do it. It's a much, much harder way to invest. And there's not a lot of, what's the word I'm looking for? There's not a lot of solidity or stability to doing that. And that's where you usually hear of people losing their shirts, is by trying to bet on, hey, I believe Palantir is going to go up to $300. And then they put their whole life savings into it and it doesn't. And then they get burned. So speculating is a much, much harder game to play. Investing does take some effort. It's not easy. And there is no shortcut to it, but you have to learn the fundamentals of the business and understand why it does what it does and why people want to keep buying cheeseburgers from McDonald's. And once you can solve that, then it's a lot easier to figure out how well it's going to do in the future. And that's what investing is. And the intelligent investor, Ben Graham, focuses on the differences between these and why one is a better way to go than the other.
Yeah, I love it. Perfect. So if we can pull on that for a second, let's say I'm a beginner. I don't know how to become an investor. Let's say I really like Nathan's hot dogs because I know they're a public company. Other than going to buy and eat some of their hot dogs, which is always a great idea, like how can I learn about this business? What are some practical ways to learn about the business as an investor?
The easiest way, I'll say easiest, as then you can access the information. There is going to be a little bit of effort required, and it's going to involve reading. You're going to have to go to, there's two main sources. One is you can go to sec.gov and you can download something that's called a 10K, or an annual report. This is something that the company puts out every year. It's a financial statement that they have to put out every year by law. And in that statement, they tell you everything you need to know about that company as a potential shareholder. You will learn what the company does, how they operate, the sectors that they operate in, maybe how much they charge for the things that they charge. You also find out the risks in investing in the business, because there is no company, no investment that does not carry some risk. It'll also include what management thinks about the company and where they think it's going, what's happened. You also see the financial records, and you also see some other maybe more minutia in things called footnotes, where you can find more detailed information about different topics that could give you some insights into the benefits of investing in Nathan's or not. So you can find that at sec.gov. It's a 10K. The ranges anywhere from 55 to 150 pages. Most public companies are going to be around the 100-page range. You get into banks, they're going to be a little bit longer because they have more regulations than other companies. And the other place you can look is most companies have what's called an investor relations tab. And so you could type in Nathan's Hot Dogs Investor Relations in Google, and then that'll take you to their website, and then they'll have other information there, as well as the sec.gov filings. So you can find all kinds of stuff, and maybe even things that aren't in the financial statements will be on that website. And it's all going to be verified, so it's good information. But those are the two places you're going to want to go. But the only way to really learn about the company is you got to read a 10K. And you have to learn how to read them. And once you do, then the whole investing world is going to open up to you and be your oyster.
I'm going to ask a difficult question. If you're not the type of person who likes to read, do you think you shouldn't be a stock picker?
If you are the person that doesn't like to read, should you not be a stock picker? I would probably grudgingly say you probably should not be a stock picker. If you cannot spend the time required to read through those financial statements, then I think investing in things like index funds or ETFs, things of that nature, your 401k, those are an amazing place to invest. Investing in stocks is a lot of fun. You can make a lot of money. You could probably make more money doing that than you can in an index fund, but there are a lot of index fund millionaires out there, and it's a great way to invest as well. And it really comes down to, what do you want to do? But if the thought of reading a 10K and learning about how Google makes money leaves you cold, then maybe it's not for you. And that's perfectly okay. There is it does not demean you in any way, shape, or form. It just means that this is not something you're super interested in. I'm not interested particularly in jumping out of an airplane. So does that mean that I'm a failure as a human? No, it just means that that's just not something I want to do. So understand what it is that you want to do and what you want to get out of this, and then decide what is going to work best from you. But don't give up until you try. You may actually like it. And it's not a race. So you don't have to read 100 of these things in a week. If you read 10K a month, that's doing better than most people, frankly. So, just understand what it is you're trying to do and set expectations. That would be my suggestion.
Yeah, if I could just throw my 2 cents in there. I basically forgot how to read when I was in my 20s. Not literally, but you know what I mean. Like, your priorities change. But I also learned I like to make money. So you'll be surprised how you can pick up that skill again. Hopefully you learned it in grade school, but you can pick that skill up again. And things that you would have never thought you found fascinating can become fascinating when there is the money element tied. And that doesn't make you a bad person either. There are psychological things that talk about how when you have skin in the game, when you have ownership stake in things, you tend to pay a lot more attention. And so, to Dave's point, if you try, you just never know where it could go. And I know for me, the journey has been a lot of fun, and hopefully I've gotten a little bit smarter. So that part's up for debate. Let's move on to inflation. How does inflation work? Does it lend itself to, how does inflation work with the stock market? And like, the way I'm thinking of inflation is, I almost need to be in stocks so I'm not losing to inflation. So like, as investors, what should we care about with inflation? Why is it doing what it's doing? I don't know. Any thoughts around inflation and stock market?
Yeah. So I think a lot of people don't totally understand the impact of inflation and why it can be very deadly to us as investors, or just people that are trying to grow our wealth, just as in general rule. And really, it comes down to our buying power. Inflation erodes our buying power. When we buy, the common analogy is to look at milk or eggs or something like that. You buy a car, or if you buy an iPhone today, the dollars that you spend to buy the iPhone today are not worth as much in 5 years because of the impact of inflation. Now, inflation right now is kind of a political hot topic, and I won't get into all the politics of it, but the big disadvantage for us as investors / consumers is that our buying power is diminished. When we buy Microsoft, the dollars that we're spending today are going to be worth less in 5 years. And so what we're trying to do when we're trying to estimate what the value of a company like Microsoft is going to be is we have to take into account the impact of inflation. And the higher the inflation, the more we have to discount how much that value will be in the future. And so we have to try to estimate that. Now, keeping in mind, these are all guesses. Nobody knows what's going to happen in the future. But when you have a fairly consistent inflation rate, the Fed's goal is always around 2%. And I think historically they've done fairly well at keeping it at that range. What it is right now, you'll hear all kinds of arguments, and that's pretty normal in the economic world. One person will say it's this, and another person will say it's that, and they're all convinced they're right. And in hindsight, they turned out they were both wrong. So it can be a challenge to come to a conclusion. But the biggest thing is understanding that your buying power is deteriorated by the impacts of inflation. And the reason why investing in the stock market is I wouldn't say safer, but a better bet in the long run for your money is because when you put it in a savings account, air quote, hiding it under the mattress kind of idea with Wells Fargo, and they're paying, 0.05% for your savings account, and you got $10,000 in there, you're losing at least 2% a year, leaving that money just sitting there. You would be better served buying something even a little more risky, like bonds or something along those lines, because kind of the evolution of investments, stocks are generally considered the best returns, but they're also arguably the most risky. And then you have things like bonds or money market funds, which are air quote safer, but the returns are not as good. Then you have government funds, government bonds, which have lower interest rates, but are considered arguably among the safest. And then you have something like savings accounts or CDs, which are probably the safest, but they also give you the poorest returns. And so when we're looking at investing and how inflation impacts us, it impacts us by the buying power of our money. So if I put $1,000 in a savings account, in a bond, or in a stock, I'm going to get more return from the stock than I will from the savings account, which is going to hopefully overcome the potential risk of investing in putting the money in the stock market. And so that's kind of how inflation impacts our investments and why it's important to understand its impacts.
Yeah, no, it's super good. And I like the breakdown of the different investment classes that we have available to us. How about businesses? Being an investor means being part owner of a business. So what is the effect of inflation to businesses, and how do they handle it? And then how does that flow through to investors?
Well, that can be a challenge too. So inflation from the top line can look good. So for example, if we saw this with the grocery stores, when the price of chicken goes up, it's a double-edged sword for a grocery store. So they charge more for the chicken that you and I are buying in the store. So the top line or the revenue growth on the financial statement, the income statement, looks great. Hey, the company is growing faster than it has in the past. That's awesome. The double-edged sword is, for investors, that part looks good. The double-edged sword is the cost of the chicken. So what they're buying it for has also gone up, because inflation has been passed through to them from the suppliers of chicken. Let's say Tyson. Tyson is the one selling Kroger their chicken. I'm not sure if they do or don't, but I'm just using as an example here. So if Tyson sells the chicken to Kroger for more, then the margins, the profit that the company makes by charging more for the chicken may be the same or worse. And so now that's impacting the financials of the business, because yes, they are charging more, so they're air quote making more money, but the profits is really what matters, because that's the money that they can use to expand and grow and reinvest and pay us a dividend and give us, buy back shares and return capital to us as investors. And if the company's getting pinched on the inflation side because the cost of chicken has gone up and now their margins are lower, then what happens is that they have less money to invest. And then we as investors will look at the company and go, well, yeah, it's great that their revenue is going up, but now they're not paying, they had to cut their dividend, or now they're not buying back as many shares, or they're not reinvesting in the business. And then eventually the business starts to slow down because they're not reinvesting. And so that's where the double-edged sword of inflation can really come back to bite companies in the public markets. And that's why we have to be cognizant of it.
What businesses come to mind when you think of those that handle inflation really well?
So a company, that's a great question. So a company that kind of springs to mind, that would be top of mind, would be a company like Costco. Costco has done a really, really good job of being able to withstand inflation over the many years that it's been in business. And they can do that in part because they have kind of a dual engine of growth. So number one, they have their subscription business, which is not impacted by inflation. And they encourage people to sign up for the subscription, which in turn drives profitability, and it also drives revenue for the company, and it gets our butts in the door. And the Costco wants to get our butts in the door because they are able to work out really good deals with their suppliers that aren't negatively impacting. Like, they're not beating up their suppliers for super low costs at the harm of the supplier, but they're also working at a fair price. And then the company has lower margins than most other retailers. And so what they're able to do is they're able to use their buying power to get better prices, and then they can pass that deal on to us as consumers. So when we go, to use chicken again, we go buy chicken at Costco, we can buy it at either a lower price or the same price that we could buy it from Kroger, but it's a better quality chicken. And we also know that we're getting the best price that we can possibly get, and it's more consistent. So the pricing isn't going to fluctuate as much. You're not going to see sticker shock when you go to Costco to buy products, because they're able to control the pricing of their products. And because they are so conservative on that aspect, then they can judiciously raise prices on things like their subscription, gently. They don't do it a lot, but they do it generally. I think they've done it every 3 or 4 years, but this last cycle was maybe 7 years because of inflation, and they wanted to hold off to do that. But the company is willing to sacrifice some profit to generate longer term returns for shareholders as well as their customers. And so that's why Costco is one of the better companies at really kind of dealing with inflation.
So companies with unique business models and competitive advantages deal with inflation better,
Yes.
Generally.
Yes.
Cool. Awesome. Yeah, that's great. So another part of the book, I'm going to move us along, is there's a chapter called A Century of Stock Market History. And this is maybe a little bit shocking to some of you, but there's actually history for the market that goes back before the internet. I know that's a crazy concept, but there's a table, goes back to 1870. It is now known as the S&P 500, but Cole's Standard 500 Composite goes back to 1871. And then pricing data for the Dow Jones Industrial, 1897. So if you ever wanted to know just how the cycles move over the years and get source data, you can pick up the book, and I recommend you do. But in the table, they highlight different years where you see the decline in each of these indexes. So when's the last time we've had a decline to end the year? It seems like over a decade where we've had any sort of decline, because even the COVID came up pretty quickly. You have declines of 28%, 38%, 33%, and it's like 1917, 1893, and then you can fast forward 1938, 1949. These are all, you have 55% decline, 30% decline, 1962, 29% decline. So a long history of market declines interspersed with his long history of great increases in price. And so to me, it kind of shows that volatility is part of the game. Stock market crashes or declines are part of the game, even though recent history has tried to suggest that it is otherwise. There are great gain periods here from 1952 until 1966. The index went from 26 to 108. So what, quadrupled in 14 years? Wow. So there are huge periods of gains, but there are also big periods of declines as well. And I think that's something to keep in mind when you're investing, because we can think that every stock's going to be like NVIDIA, but that's not what history has shown.
Not at all. And that's one of the beauties about looking at the history of the stock market, is it can give you a little bit of confidence and a peace of mind when we are going through a rough patch or a rough spell, to understand that this has happened before and it will happen again. And it's part of the part of the game of investing in the stock market, and also understanding that, when you hear bigger numbers like that, 38%, 49%, 55% down for a year, and then understand that over that same period, the market as a whole has returned around 10%, give or take, during that same period, it shows you the ups and downs that we can go through, the volatility, the roller coaster, if you will, that we can go through and still have good returns at the end. And I think that also shows that patience is a virtue, and it can help you, earn better returns in the stock market.
Yeah, very well said. While we're on the topic of the market, one of the big, huge lessons from The Intelligent Investor was this idea of Mr. Market. What about Mr. Market has kind of shocked you, or like how the last couple of years have been a little crazy in the markets? You could argue the last 5 plus. I'll ask you this, what have you learned about Mr. Market that you didn't know in the past? And then briefly just describe what the Mr. Market idea is in case somebody's new out there.
If you're unfamiliar with The Intelligent Investor or what Mr. Market is, it's probably one of the central themes that one of the big takeaways is part of one of the chapters that Warren Buffett has talked about so glowingly. And it basically is Ben Graham created this Mr. Market character to explain the schizophrenic nature of the stock market. And in essence, what it does, it explains why company A will trade for a really good price one day and trade for a really bad price the next day, when there's really no news that has come out that would potentially impact the sentiment of the market about the company. And so Mr. Market was his kind of allegory to illustrate the craziness that you can experience in the market when you invest in any particular company. And it does not discriminate. It can and will pick any company at any particular time, and it is not
Seagate.
unusual. Yeah, right.
We just talked about the last episode. You go check out our not Spotify Wrapped, our stock market Wrapped for 2025. Yeah. Some of the companies in there just absolutely exploded for the year, and it's like, are they really that different of businesses?
Right. Is it really that great? And likewise, there's some other companies that have been hammered for the year, and are they really that bad? Maybe they didn't perform great, but are they really that bad? So market sentiment can be very, very irrational. One of my favorite examples recently is what's happened with Google. A year ago, Google Alphabet was on the sentiment train to Nowheresville. It was probably of the Mag 5, 7, 10, whatever. It was probably one of the least favored companies, and everybody was predicting the doom and gloom of Google search, and Google is going out. ChatGPT is taking it under. 2 years ago, Bing was taking it under. That didn't come to pass. ChatGPT was now going to be the death of Alphabet. And you fast forward 7-8 months later, and it's now up 60-70%. And really nothing has changed much. It's just that now the sentiment has changed, and the company is still operating. They're still growing revenues at roughly the same rate they were a year ago. Margins haven't really expanded, exponentially. The cash flow that the company generates is roughly the same. Like really financially, it really hasn't changed. It's really been the sentiment about the business and their execution. And everybody thinks that now they can execute, whereas 6-8 months ago, nobody thought they could execute. So that's not unusual. Meta went through a similar phase a couple years ago where everybody was hating on Zuckerberg and Meta, and it was going down. It was trading at $75 a share or something like that, and a PE of 11 or 12. And now I don't even know what it's trading for, but it's up hundreds of percent since then because the sentiment has changed drastically on Meta.
So what did you do? Because I know you own Google. What did you do? What was it, 7-10 months ago? How did you react as an investor 7-10 months ago when there was all that sentiment around Google?
I bought more.
Yeah.
I bought more because it to me, it was, I thought all the negative hype was hullabaloo. I just thought it was, much ado about nothing. And you looked at the numbers, you looked at the way the behavior of the people that use Google search, that hasn't changed, and it wasn't changing. And they've been a leader in AI, and yes, they may have had a few missteps, but it doesn't mean that, Sundar Pichai had lost his touch or he didn't know what he was doing and made some mistakes. And now the company is air quote humming on all cylinders. That's what the sentiment is, but it really hasn't changed. And so to me, when the market, was so negative about the company, it was like, offering me up, pumpkin pie with whipped cream, on a plate, to eat.
Yeah.
Like,
Yeah.
I'll take some of that.
How did you kind of stiff arm all that narrative and all the hullabaloo, and how did you ignore all the people who are so down on the company? Because that can sometimes, you can sometimes feel that as an investor, especially if the stock is down, like it was down at the time.
Yeah, it was down. For me, it was, I felt like, first of all, I try really hard to focus more on the fundamentals of the business and what I see happening with the business itself, as opposed to what people are talking about out in the market. I think it's really easy to get wrapped up in the news, social media, and all the hype of everybody, because you'll discover very quickly, if you've never been on Twitter before, that everybody there is an expert of whatever the topic is of the day. Everything. And they can go from being macro, economic experts to tariff experts to experts on, a war somewhere, to what's happening with Google. And so for me, a lot of that is I mostly take that with a grain of salt. So I try to focus mostly on the fundamentals of the business, what I see happening with the company, and listening to people that I know and trust and listen to their viewpoint. Sometimes good and sometimes for and sometimes against, because you can actually learn a lot from people that are against something. But if they're coming at it from a place that you acknowledge they know what they're talking about, then it can give you some counterpoints to, invert that idea. Okay, they're saying that this is happening. Do I think that? And then you can go out and try to disprove that to yourself. And if you can, then maybe you're onto something. And so it's kind of this idea. Charlie Munger talks a lot about, inversion, always invert idea. And to me, when I'm looking at a company like Google, when they're going through a downturn, I want to think for myself, but I also want to take guidance, or not opinions, but I want to take information from other people that I trust, and try to determine if I think they're right or not. And in this case, I thought that the market was wrong, and so that's why I wanted to buy more.
That's too rational, Dave. Can't be saying this is the stock market. Come on now, can't be so.
In reality, I took my little black eight ball thing and shook it up really hard, and I said, "Should I buy Google?" And it said, "Signs are good."
That is also an approach. Okay, so there is one last huge concept that Warren Buffett raved about when it came to the intelligent investor, and it is in chapter 20. And really, like, if you bought The Intelligent Investor and you just read chapter 8 and chapter 20 and call it a day, you've gotten 80-90% of the book and you are solid. So that just alone is worth the value for the money to pay for that. Explain margin of safety for us, for a beginner, and then what have you learned in the last 5 years that maybe has changed the way you look at margin of safety as an investor?
Well, I think you're right. The margin of safety from The Intelligent Investor is probably the cornerstone concept of the book. And I would argue that it's probably the thing that Warren Buffett is probably most known for, is his idea of how he approaches the margin of safety. And what the margin of safety is basically, it means when you're buying a stock, that the price that you're buying it for is significantly below what you think the intrinsic value or the value of of that business is. So for example, if you want to go buy Google again and you think the company is worth $100, but it's selling for $70, that's a $30 margin of safety. So if you are wrong, air quote wrong, on some of your estimations of what the company is worth, then when you buy the company, even if you miss a little bit, you're not going to miss that big. And a big part of investing is protecting your capital. And so, protecting the downside, Monish Pabrai, one of our favorite investors, his favorite phrase was, heads I win, tails I don't lose that much. All those things kind of revolve around this idea of margin of safety, of having a buffer between what you pay for something and what you think it's worth. Whether it's a house, whether it's a car, whether it's a stock, it's all the same concept. And that's what Ben Graham was talking about in the book.
Yeah.
So,
and have your thoughts evolved about what exactly that means?
Yes, they have immensely. So when Andrew and I first started this journey all those years ago, I was very much about the numbers, and the numbers would tell me a story. And it was all about, okay, if I'm going to buy a company like Google, I have to buy it at a 30 to 50% margin of safety, because if I'm wrong, then I don't want to get burned. And as I've, I guess, evolved as an investor, as I've learned more, I think there's still a lot of truth to the part of the numbers. But the trick with learning how to value companies is that it's part science and it's part art. And the science part is arguably easier because it involves numbers and you can apply numbers. The trick is that those numbers that you're using, by and large, are estimates. And so we have no way of knowing exactly. If I think that Google is going to grow, for example, at 10% a year, that's my estimation. I have no way of knowing that that is exactly going to happen. And I'm basing my investment on the fact that I think that Google will grow at 10% a year. So what happens if it only grows at 9% a year, or 8.5%? Or what if it grows at 11% a year? Does that necessarily mean that the investment's going to go up or down? Not necessarily. And that's where the science part or the art part comes into it, because now you're trying to take into consideration how strong is the business's position in their market. What kind of competitive advantages do they have over their competitors? Or are they trying to compete against a stronger competitor, and how are they trying to, air quote, take their moat down, kind of thing? So, and all of that goes into the impact of how much you pay for the company and how much you're willing to pay for the company. How much do you think, how big is the opportunity in front of the company? And how much do you think that they can take of that? And without getting into the whole TAM, and discussions about that, I always get the heebie-jeebies when I think about that, because I always remember Uber saying the TAM was the world, and that always just kind of gives me the heebie-jeebies. So, but I think when you're thinking about the art part of investing, you have to take into consideration the sentiment around the business at the particular time. You have to take into consideration who's running the business. Are they going to be there for the next 10 years? Is the founder CEO that's been Jeff Bezos, he's leaving next year. You're going to buy the company in 3 months, and Jeff Bezos is leaving. How is that going to impact the investment? It's probably going to impact it some. And so you have to consider all those things. So that's all part of developing a margin of safety, is using the numbers to help you paint a narrative that you can think about how the company is going to react to market forces and how you think this business will do in the long run. Because again, we're buying a business. We're not buying a static ticker or an Excel spreadsheet. We're buying a business that's run by people that serve people, and we have to account for those, eccentricities, if you will.
So let's use the Google as a hypothetical. How would you determine, how would you differentiate between, like, I'm going to estimate Google is going to grow at 10%, and then I'm going to estimate, I don't know, let's throw a random company under the bus, Fiserv is going to grow at 5%. How do you make that kind of determination? or how should an investor make it?
There's kind of three different ways that I look at trying to do that. Number one, the before you do any of that, the first thing you have to do is you have to read a lot about the company. You have to understand what their business model is, what it is that they do, and kind of understand what kind of opportunity could they potentially have. Once you have that kind of idea, then there's three main ways that you can kind of estimate growth for companies. Number one is you can look at the historical numbers. You can look at what the company has done in the past. And in some cases, you can project that forward. It's not a guarantee. Just because Google grew at 10% last year doesn't guarantee that they will grow at 10% next year. But it can be maybe a base for looking at, okay, is it reasonable to expect Fiserv to grow at 25% a year when they've never done that in the history of their business? Probably not. So that can help ground your expectations, if you will, is by looking at what they've done historically. The next thing that you could do is you can look at what analysts, what other experts are saying about the industry, keeping in mind that there are incentives that drive them to make the estimates that they make. So not necessarily saying they're lying or that they're wrong, just that there could be some unintentional biases there. So you have to kind of take it a little bit with a grain of salt. So, and then the last one is looking at the fundamentals, looking at what the company is doing. How are they reinvesting? How much are they reinvesting? How well are they reinvesting? Because those will all go towards telling you how well the company allocates the capital that it earns. And the better it allocates the capital that it earns, the better returns it should get over a long period of time. And that can help you get an estimate of what you think the company will do in the future.
Yeah. And if that sounds like a lot of work, it is. And there's a reason why people pay fund managers. I would recommend, if anybody out there is looking for guidance and looking for ideas with a margin of safety, to check out Dave's research, Value Spotlight. Every month he's putting out a new idea with a margin of safety and talking about why he thinks this company will grow at whatever the number is. Because you're always saying what the number is in the write-up. And so it's a way to see, I invest my money with it, you invest your money with it. It's a way to see how investors in real time are putting their skin in the game and what the thought process is behind that.
Yep, exactly. Yeah, it's where we basically, it's our investment diary. It's where we document what we're doing, how we're thinking about it, and how our thoughts may evolve on particular companies and whatnot. So it's a great resource for me to help learn. Because Andrew has a whole archive of like all kinds of great work that I can lean on. So it's very helpful.
Awesome. Any last thoughts on the intelligent investor? If somebody's on the fence and is just like, man, I'm kind of lazy, I don't know if I want to even read 2 chapters, I'll just get the AI summary. What do you say to that person? And just what other encouraging words do you have for the book itself?
Well, I think we've proven over our discussion today that this is a timeless book, and there's a lot to learn for all stages of investors from this book about how to approach investing in today's age. So I would encourage everybody, if you're starting to invest or you've been investing for a while and maybe you've struggled and you don't know why, reading this book could be the great unlock to help you find a better way forward for your own investing. As far as people that are like, just the whole reading thing just leaves me cold. Yes, you can do AI summaries and whatnot. And while they're okay to give you a flavor of what's going on, the actual reading of the book will impart the knowledge much, much better. I know that writing is a much better way of learning things, but reading is actually also a great way to learn things. And if reading is just not your thing, I know that Spotify Books, if you have a premium subscription, has The Intelligent Investor in their library, and you could listen to it on the way to work. You could listen to it on the bus, on the subway. You could listen to it while you're working out. Instead of listening to your death metal, you could listen to Ben Graham.
Hey, whoa, whoa,
so,
whoa, whoa. Hey, you want me to get a pump or not? Come on now. Now you've crossed the line.
Yeah, I crossed the line. Sorry. Take a walk. Go for a walk
Yeah,
in the woods.
yeah.
Not only will it refresh your mind, but you'll learn something as well. And it's a pretty easy book to read. Frankly, most people are maybe afraid of it, but there's not a ton of numbers in there, and it's more philosophy and education than it is like numbers. It's not accounting. So, and it's actually, if you listen to it on audiobook, it's actually quite enjoyable. And if you do nothing else, if you don't want to listen to the whole thing, at least go to chapters 8 and chapter 20 on the Spotify book and listen to those. Put them on repeat and listen to them 5 times. You will learn so much just by listening to those 2 chapters alone. This is something that I do every year is I go back and reread the book. And it's very, very, very helpful. So I strongly encourage you to consider reading the book.
What I'll say too is there are different times in history where people have said Warren Buffett was behind the times. Warren Buffett can't keep up anymore. And just like clockwork, his returns, his ideas have come back in style. And the Intelligent Investor, I feel, is a similar kind of thing. And if you don't believe me, ask yourself one very important question. How did New Balances become cool? Okay, that's an old generation thing, and now they're cool. Ask yourself, how did that stuff become cool again? In the stock market, you'll find that that's actually happens a lot too. These styles go in and out, but the timeless principles are always there. And the best time to read a book like this is when nobody else is reading it.
All right, folks. Well, with that, we will go ahead and wrap up our show. Welcome to 2026. I hope you enjoyed the show today. And if you have any questions or any topics that you would like us to discuss, please reach out to us at newsletter@einvestingforbeginners.com. We read every email. Or send us a message on Spotify. You can do that through the podcast app, or reach out to us on the socials, either X or LinkedIn. And we would be happy to start a discussion or answer your questions on the air. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.